You want to buy a house with almost no money down, even with credit scores as low as 500? You can. It's called an FHA loan, and in this video, we're diving deep into the 2025 FHA loan requirements. We'll break down the numbers, clear up common myths, and even show you exactly how FHA mortgage insurance works. First, let's get something straight. FHA loans are not just for first-time homebuyers. There's a huge misconception that only first-time homebuyers qualify. But that's simply not true. Anyone can use an FHA loan, whether you're buying your first home or your 10th. And it's not just for people with low credit scores or tiny down payments either. Now sure, FHA loans allow lower scores and smaller down payments, but even if you've got an 800 credit score and 20% down, you can still use FHA financing. So why are we focusing on FHA loans instead of conventional VA or USDA loans? It's simple. FHA has the most flexible guidelines when it comes to qualifying. They allow lower credit scores, smaller down payments, and higher debt to income ratios, meaning you can carry more debt and still qualify for a bigger home compared to other loans. Now, let's talk about credit scores. One of the most important factors in FHA approval. People hear that FHA allows scores as low as 500 and think, great, I have a 500 or 550, I'll just use an FHA loan. But it's not that simple. Yes, FHA accepts credit scores as low as 500, but here's the catch. You'll need more money down. FHA offers a minimum payment of 3.5%, but to qualify for that, you'll need a credit score of at least 580. If your score is between 500 and 579, you'll have to put at least 10% down to qualify. That means 500 to 579 credit score is 10% down required. 580 plus credit score is 3.5% down required. Now here's where people get confused. Someone with a 579 credit score and 10% down might think, great, I'm approved, but not so fast. Having the minimum score and down payment does not guarantee approval. The lower your score, the tougher the approval process. Loans with lower credit scores often require manual underwriting, meaning lenders will go over every single detail with a fine-tooth comb. If your credit score is higher, they still review everything, but they won't be as strict as compared to lower credit score applicants. Now, let's get into the real numbers. Most FHA borrowers go for the 3.5% option down. So what does that look like? For a $100,000 home, that's $3,500 down. For a $200,000 home, that's $7,000 down. For $300,000, it's $10,500 down. So you get the picture. And yes, the numbers do go up from there. But wait, there's one more thing you need to know about before you get an FHA loan. FHA loans comes with loan limits, meaning there's a maximum amount you can borrow, and it varies based on where you live. So before you make any moves, check your local FHA loan limits to see if this option works for you. If you're in a low-cost area, your FHA loan limit is going to be lower than if you're in a high-cost area. Simple as that. So if you live somewhere like Southern California where prices are sky high, you'll have a much higher loan limit compared to, say, the Midwest, where I am, where housing is generally more affordable. Now, if you're wondering whether you live in a high-cost or low-cost area, check the description in the link, and I'll hook you up with my mortgage guy, and he can let you know about that information, about where you are in the area. These limits can change every year, and because this video was filmed before the latest updates, I won't throw the numbers on the screen. Instead, check the comments section where I'll post the latest FHA loan limits as soon as they're available. Now, what happens if you want to buy a home that costs more than the FHA loan limit? You still have options. You can still use an FHA loan, but you'll have to put more money down to bridge the gap. However, most people stick to the FHA loan only when they want to take advantage of their lower down payment, typically 3.5% down. So if you're exceeding the limit, it might make sense to explore other options. Now let's talk about mortgage insurance. FHA loans often get a bad reputation because of mortgage insurance. You've probably heard people online saying things like, never buy a home unless you have 20% down to avoid mortgage insurance. I would never buy a house with mortgage insurance. It's a ripoff. But let's be real, mortgage insurance is just part of the deal. Unless you have 20% to put down, you're going to pay mortgage insurance no matter what loan type you choose, whether it's FHA or conventional. It's just the cost of doing business in the mortgage world. Now, here's really what matters. FHA changed the rules a few years ago, and now mortgage insurance lasts for the entire life of the loan if you only put 3.5% down. That means even if you gain equity, you're still paying mortgage insurance every month. However, there's one exception. If you put at least 10% down, your FHA mortgage insurance will automatically drop after 11 years. That's the key difference to keep in mind. Now, can you refinance out of FHA? Yes, you can refinance out of an FHA loan later on, assuming you qualify. A lot of people start with FHA, build up some equity, pay down their loan balance, and eventually refinance into a conventional loan to get rid of mortgage insurance altogether. That's the strategy if you don't have 20% down, but want to eliminate mortgage insurance later. Later in this video, we'll break down exactly how to calculate your FHA mortgage insurance payment. But before we get into that, let's pause for a second. If you're getting value from this video, hit the thumbs up. It helps to push this content out to more people who need it. Also, subscribe if you want to stay updated on everything related to the real estate world in Little Rock, Central Arkansas, mortgages and things like that. So, let's talk about debt to income ratio. This is what you need to know. FHA loans are so popular because they allow for higher debt to income ratios compared to other loan programs. But what exactly is a DTI ratio? Let's break it down in the simplest way possible. Your DTI ratio is your monthly debt reported on your credit report compared to your gross monthly income. What's not included? Cell phone bills, utilities, groceries, childcare, none of that counts. These are expenses that should be considered for your personal budget, but they don't show up when you apply for a mortgage. Now, what is included? Any debt that appears on your credit report. Car loans, credit card minimum payments, student loans, personal loans. Now, FHA is incredibly flexible with DTI ratios. They allow 47% front-end ratio, which is housing costs only, 57% back-end ratios, which is housing plus all other debts. Now, what's the difference between front-end and back-end ratios? Front-end ratio, this is your housing expenses only, your mortgage payment, property taxes, homeowners insurance, HOA fees, no utilities, no gas, no groceries, just housing related costs. And the back-end ratio, this includes everything, your housing expenses plus all your other debts, such as car loans, student loans, credit cards, etc. If you have no additional debt, your front-end and back-end ratios will be the same. But if you have a lot of debt outside of housing, your back-end ratio will be higher. Now, let's do some quick math. Let's say you make $120,000 per year. That's a nice round number to work with. First, we divide that by 12 months to get your gross monthly income. It's $120K divided by 12, which is $10,000 per month. This is the number lenders use before taxes and deductions. Now let's figure out your monthly debt. Let's say you have a $500 car payment, $500 in credit card minimum payments spread across 5 cars at $100 each. That's $1,000 in total debt per month. Let's add in your housing expenses. Mortgage payment, $3,000. Property taxes and insurance, $500. HOA fees, $500. So total housing expenses of $4,000 per month. Now, we calculate your front-end ratio. $4,000, which is your housing expenses, divided by 10K, gross income. That's 40%. And since FHA allows up to 40%, you're in the clear. Now, let's calculate your back-end ratios. That's the $4,000 for housing, $1,000 for other debts. It's $5,000 total per month. So 5,000 divided by 10,000 is 50%. Since FHA allows up to 50% on the back end, you still qualify. So why should you rely on these DIY calculations? This breakdown is just for educational purpose. Do not assume you qualify for a loan just because your math seems right. Always talk to a lender first. They'll run the actual numbers and let you know where you stand. And if you're looking for a lender, check the info in the description. I've listed professionals I know and trust who can walk you through the process. You don't have to use them, but if you need a starting point, they're great options. Even if you start with the recommended lender down below, take a minute to visit your bank or other loan officer to get a competing quote. And if you begin with your bank, use the referrals below and compare that quote, just to be 100% sure you're getting a fair deal. Here's the good news. This process is free. You shouldn't have to pay anything just to get pre-approved or receive loan estimates. So why not take advantage of it? This is your chance to make sure you're getting the best possible loan terms without hidden fees or unnecessary costs. Not all banks play by FHA's rules. Here's something most buyers don't realize. Just because you meet FHA's official guidelines doesn't mean every bank will approve you. Some banks have extra requirements called overlays that make it harder to qualify. For example, FHA allows credit scores as low as 500 with 10% down, but some banks won't lend to anyone under 640, even if FHA allows it. That's why going to a mortgage broker can be a game changer. Brokers with multiple lenders, so if one bank denies you because of overlay, they can shop around and find another lender that will approve your loan. At the end of the day, working with the right professional is key, whether you're going through a referral or you're finding your own lender. Make sure they have options and truly know the FHA loan inside and out. And again, if you need a trusted recommendation, I have some options in the link below for someone who can help. Now, what about FHA interest rates? One of the most important questions, or one of the most common questions people ask, what are interest rates for FHA loans? Well, in most cases, FHA rates are lower than conventional loans. This is especially true for buyers with lower credit scores or smaller down payments. FHA often gives them a better deal than a conventional loan would. But here's where things get tricky. You also have to factor in mortgage insurance. So, how does mortgage insurance work? The great thing about FHA mortgage insurance is that it's the same for everyone. As long as you're putting 3.5% down, the mortgage insurance rate is locked in at 0.55% annually, no matter what your credit score is. Now, you're probably wondering, what does this actually cost? Let's break it down. Let's say you're buying a $350,000 home with an FHA loan. Assuming you have a credit score of 580 or higher, you only need to put 3.5% down. Number one, you're gonna calculate the down payment. That's $350K times 3.5%, which is $12,250. Your loan amount starts at $337,750 after the down payment. But FHA has an extra fee, upfront mortgage insurance. FHA upfront mortgage insurance is 1.75% of the loan amount, and it's required on every single FHA loan, no matter your credit score or down payment size. So, $337,750 times 1.75% is $5,911. That brings your final loan balance to $343,661 after rolling in the upfront mortgage insurance. Now let's calculate the monthly mortgage insurance. The annual mortgage insurance rate is 0.55% of your loan amount. The $343,661 times 0.55%, that's $1,890 per year, $1,890. Divide that by 12 to get your monthly cost. $1,890 divided by 12 is $157 per month for mortgage insurance. So, on top of your regular mortgage payment, you'll pay around $157 per month for FHA mortgage insurance. Now, this is just one example. Your numbers will vary based on your loan amount, down payment, and other factors. But this should give you a clear idea of how FHA mortgage insurance works. Now, to break it down further, we divide that yearly mortgage insurance cost by 12 to get the monthly amount. In this case, on a $350,000 home, your monthly mortgage insurance comes at about $158. You can use this same calculation on any purchase price to estimate your monthly insurance costs, your monthly mortgage insurance costs. But, and this is important, treat this as a rough estimate, not an exact number. Talk to a mortgage professional to get the most accurate numbers for your specific situation. So far we've covered credit scores, down payments, mortgage insurance, and debt to income ratios. Now let's talk about the types of properties FHA allows, because FHA does not approve all property types. FHA loans are only for primary residences. That means you must live in the home in which you're buying. If you're trying to buy an investment property with no intention of living in it, FHA won't approve the loan. But here's a question that comes up all the time. Can I buy a home as my primary residence and then turn it into a rental later? And the answer is yes. There's no official rules stating how long you must live in the home, but most lenders recommend at least a year before converting it into a rental. Let's talk about a big FHA loophole, one that lets you buy an investment property while still using an FHA loan. And I'll call this the multi-unit loophole. If you buy a multi-unit property like a duplex, triplex, or fourplex and live in one of the units, you can use an FHA loan, even though you'll be renting out the other units. And here's the best part. You can still put down as little as 3.5%, even on a 4-unit building. That means you could live in one unit, rent out the others, and potentially have your tenants cover most or all of your mortgage payment. But here's the catch if you're buying 3 or 4 units. FHA has something called the self-sufficiency test. This means the rental income from the property must cover a certain percentage of the total mortgage payment. So if you're buying a single family home or duplex, you don't have to worry about this test. But if you're trying to buy 3 or 4 units, which is 3.5% down, this rule applies. So what exactly are units? When we say units, we mean separate living spaces within a property. So a duplex is 2 units, 1 building, 2 separate entrances, 2 residences. Triple is 3 units, which is 1 building, 3 separate residences. And a fourplex is 4 units, one building with 4 separate residences. In some cases, you might see 2 separate houses on the same lot. This can count as a duplex in some situations. FHA loan limit increases with more units. One last important thing to note, as the number of units goes up, so does FHA loan limits. That means if you're buying a duplex, triplex, or fourplex, you can actually borrow more than you could for a single family home while still putting 3.5% down. Now, if you're serious about house hacking or buying multi-units with FHA, make sure to run everything by your lender during the pre-approval process. Not all areas have the same loan limits, and high-cost areas like Southern California, they make it much harder to qualify for multi-units with a low down payment. But in more affordable areas like Central Arkansas, this can be an incredible way to start building wealth through real estate. Now let's talk about FHA property requirements and what you need to know. Before you can buy a home with an FHA loan, the property must meet certain minimum standards. If you're purchasing a single family home, you're usually in good shape. FHA automatically approves single family homes as long as they meet basic safety and livability standards. That means no peeling paint, a working heating system, no major health or safety hazards. Basic appliances must be present, and most homes pass these requirements so easily, so it's not usually an issue. But if you're looking at condos, things can get more complicated. So let's talk about FHA loans and condos. If you're using an FHA loan to buy a condo, the entire condo complex must be on the FHA approved list. And here's the problem. Many condos aren't FHA approved because they haven't gone through the approval process. So if you're looking at a condo not on the approved list, you have 2 choices. You can request a spot approval for your specific unit, but be prepared for a long, slow process. Or number 2, find a condo that's already FHA approved. If you're not sure if a condo is FHA approved, ask a local real estate expert. Sometimes condos are listed under different names, and a professional can help you dig deeper to find out. One of the biggest factors in FHA approval is your job and your income. FHA requires that you have at least 2 years of steady employment in the same field. But what does that actually mean? If you've been at your job for 2 years, you're in great shape. If you've changed jobs but stayed in the same industry, you should still be fine. If you switched from a W-2 salary job to a self-employed or commission-based job, that could be a problem. Here's an example. If you start as a hostess at a restaurant and later get promoted to server, FHA counts that as the same job field, even though your position changed. But if you go from working a W-2 job from where you get a paycheck to a 1099 commission job like a real estate agent or a loan officer, FHA might not approve your loan unless you've been self-employed for at least 2 years. So the key takeaway, your income must be stable and consistent. Now, what if your income fluctuates? If your earnings go up and down too much, that could cause issues. But if you have a steady trend like earning $50,000 one year, $45,000 the next, and then $55,000, you're probably fine. Now, don't try and figure this out on your own. This part is crucial. Don't just assume you qualify based on your own calculations. Talk to a mortgage professional. They can analyze your income and make sure you're actually eligible before you start making offers. Nothing's worse than falling in love with a home only to find out you don't qualify for financing. If you're wondering where to find a trusted lender, check out the referral links below for loan experts who can guide you through the process. All right, so are FHA loans good or bad? There's a lot of misinformation out there about FHA loans. Some people say FHA loans are terrible, avoid them at all costs, but that's simply not true. FHA loans can be a great option if you have a lower credit score, need a lower down payment, want more flexible approval guidelines, and at the end of the day, the best way to decide if FHA is right for you is to compare your loan options. Have your lender show you FHA versus conventional versus other loan types, and you can make the right choice that fits your situation best.